All right, and with that, hello everybody. My name is Jonah Crane. I'm a partner at the Klaros Group. We're an advisory and newly an investment firm in the financial services space. We spend an awful lot of our time working with fintechs and banks who are partnering to provide innovative financial services. So it's with great pleasure that I get to moderate a panel today with policymakers who are on the front lines of working through some of these issues. So let me start by being lazy moderator and ask my panelists to introduce themselves so that I don't screw up their titles. So Kavita, let's start with you.
Great, thank you, Jonah. Hi, everyone. I'm Kavita Jain. I'm with the Federal Reserve Board. I oversee the novel activities and innovation policy function over there. Thank you, Jonah, for willing to moderate this panel, and thank you to the American Fintech Council and Phil for inviting me here.
Right. I'm Mike Brickman. I'm from the Office of the Comptroller of the Currency. I am a Deputy Comptroller in our Midsize and Community Bank Supervision line of business. I am responsible for the Specialty Supervision Division, which includes 4 divisions, 2 of which are probably interesting to this group. One is our Novel Bank Supervision Unit, which is supervision of all of our novel community banks. And then the second is our Regional Technology Service Provider portfolio, which is all of the regional service providers that kind of fall below the threshold of being a significant service provider.
Natalia.
Hey, good afternoon. My name is Natalia Lee. I'm the Director in the Office of Consumer Policy at the Treasury Department. My team and I have a privilege to work on a broad range of issues as we sort of formulate and inform the Treasury policy positions on economic, regulatory, and legislative proposals affecting consumers. These can include, emerging products and services, fintech, financial inclusion, access to credit, among many others. And my team also leads and coordinates the Financial Literacy and Education Commission, which is an interagency body that's chaired by the Treasury Secretary. So good to be here.
Hi, I'm Wade-Gery. I'm a senior advisor to the director of the CFPB. I've been at the CFPB since its founding in a variety of roles. As a senior advisor, I mostly work on some of our larger rulemakings like Section 1071 and Section 1033. We have other names for them, but as a lawyer, that's how I think about them.
All right. Well, and as an architect at Dodd-Frank or somebody who worked on it all those years ago, I recognize those sections. So even some, most of them anyway. So let's kick off and let's start by actually following the rules for a minute, talking about the topic that is the name of our panel, novel activities and novel activity supervision. Kavita, let's start with you, since the Fed recently launched a supervision program by that name. Why don't you tell us a little bit about that program, sort of where you are in implementing it?
Yeah, sure. So the Fed, let me just start by saying that the Fed supports responsible innovation. We are starting to see banking organizations engage in a range of novel activities related to crypto assets, distributed ledger technology, complex fintech partnerships. And as with any significant innovation, these activities have the potential to offer a lot of benefits to the banks, to consumers, to the financial industry at large. But again, as with any new significant innovation, these activities can also pose significant risks and novel manifestations of risks that can affect the safety and soundness of banks, that can affect, again, the financial system at large. And so the Fed's approach to supervision and regulation is really focused on supporting innovation while ensuring that the risks are appropriately addressed to ensure safety and soundness of banks and just broader financial stability. The Novel Activity Supervision Program that Jonah mentioned, we launched that in August. The program is focused on enhancing the supervision of these activities to make sure that the risks are appropriately managed while supporting innovation at banks. The program focuses on 3 types of activities: those related to crypto assets, those related to distributed ledger technology, and those related to complex bank fintech partnerships, which I imagine is of great interest to this audience. The program also scopes in firms that are concentrated in providing banking services to the crypto and fintech industries. To be clear, though, as Vice Chair Barr has noted in his speeches, Banking organizations are not prohibited or discouraged from servicing or providing services to the crypto and fintech industries, or any industry for that matter. The focus of the program is on concentration of services to a particular industry. As we've seen, unfortunately, in recent past, banking organizations that focus on servicing the crypto industry are exposed to significant liquidity and other risks, which can affect the safety and soundness of the banks. So why did we set up this program? Again, the goal of the program is to ensure that there is appropriate supervision of novel activities, that there is a centralized, dedicated team of experts that can focus on new developments in this space, that can engage with banks on understanding risks in this area and managing those risks. It is set up, I should mention one more thing. That is an important part of this program is to really having a centralized team helps the Federal Reserve rapidly advance its knowledge in this space. Crypto and fintech markets are rapidly evolving, and the role banks want to play in this space, the types of partnerships and structures that are being set up are also rapidly evolving. And so having a dedicated team that monitors, tracks, educates itself in this space, engaging with banks, helps us ensure that we are keeping up and continuing to enhance our expertise in this area, and also helps with consistent supervision across the system. I'll just mention one last thing. The program is set up as a hybrid national model. You heard from Mark, the Fed is known for having complex structures and setups. But really the idea is that we're not creating a separate portfolio of banks. Banking organizations that are engaged in this space continue to coordinate directly with the traditional supervisory teams. The program will have dedicated experts that will then work as part of those traditional supervisory teams, but they'll provide the expertise that is needed to supervise in this space. This helps really minimize any burden on banks. It creates efficiencies because we're just leveraging existing supervisory processes and structures. And then just one last thing I want to note is that the program is risk-based. So the level of supervision and monitoring really will depend on the type of activities and the level of risks that those activities may pose at the bank.
I found the structure of this program to be really interesting, and you have led a team at the Fed for years, and at FINRA before that, that is really tasked with engaging with the innovation community, learning about what's going on out in the marketplace, and then bringing that expertise back to bear. And this seems like a real direct and natural extension of that, where you're bringing targeted expertise out into the field, into the exam teams, and actually into the supervisory process. And so I think it's a real interesting extension of the work that the Fed and others have been doing. If I'm not mistaken, banks will be notified if they're within this novel supervision program, so they'll sort of know to expect.
Right.
Right. I have a couple follow-ups, but I want to get to Mike real quick, because the OCC took a very similar step, but took in a slightly different way. So I'd love to hear from you, Mike, how to sort of compare and contrast how the OCC is going about a very similar thing.
Absolutely. So similar to what Kavita said, we had some of the same thought process around trying to bring greater expertise to the organization by consolidating the supervision of our novel banks under one portfolio. That's the one really probably significant difference with what the Fed has done, is we at the OCC chose to actually bring all of the banks into one single portfolio managed by one assistant deputy controller that reports up to me as the deputy controller, to ensure consistency of decision making, and to ensure as we're building that expertise, we can actually become much more efficient in terms of authorizing activities when banks ask or request for no supervisory objection. So we're partnering very closely within our agency with our policy group, our Office of Financial Technology, to make sure that we're building the supervision expertise to have that really direct supervision approach where the banks can talk directly to the same manager, get the same response to the question, and so we're treating similar products and services the same way. It's a little bit of a break from our traditional community bank supervision model, where we classically have decided that community banks should be supervised by someone geographically close to where they're situated. 99% of the time with our novel banks, that geographic proximity is far less important than the technical ability of the supervision team, and that's why we decided that the portfolio would be better served by bringing it together.
Got it. So let's get practical for a second. How is this going to work in practice? And there may be nuances as between your agencies and a little bit of a difference in how things actually work. But from a practical perspective, I'm a bank. I'm engaged in a handful of fintech partnerships. The Fed or the OCC decides that activity is complex or novel, and I'm now eligible for this sort of enhanced supervisory regime. How should we think of this playing out? Should we expect revised new exam manuals targeting this kind of activity over time? There's obviously some guidance on the books, and we can get into this in a little while about how to manage third-party relationships, but it's not super bespoke for these kinds of relationships. So how should we think about this playing out over the next, the early days of this program, if you will?
So I want to start off by just clarifying that the Novel Activity Supervision Program is focused on what we refer to as complex partnerships. So what I'm not referring to are arrangements with traditional vendors or fintechs that provide back office solutions, or partnerships that involve your typical white label debit or credit card. What we're focused on are complex partnerships where there are one or sometimes multiple fintechs involved in delivering the banking product to the end consumer. And what we've seen is that these partnerships oftentimes have multiple layers of intermediaries that can obscure risk. They may have concentrated lending exposures. They may have high payment processing volumes, or as we heard on the previous panels, sometimes banking organizations will delegate certain responsibilities to the fintech partner. And those things create newer or novel manifestations of risk. And you'll hear me say that a lot. I mean, they're at the end of the day, traditional liquidity risks are operational risks, but they manifest in different ways. And we're starting to see banks that are growing rapidly when they have these partnerships, but their risk management, governance frameworks, their compliance frameworks are not able to keep up with that rapid growth, and ends up being deficient. And so to answer your question in terms of approach, these activities were being supervised by the traditional supervision teams even before this special program or novel program was established. The difference here is now the traditional supervisory teams will now have these specialized examiners join them. And as with any banking organization, our supervisory approach is risk-based. And so if we see that there are banking organizations, community banks included, engaging in novel activities that warrant kind of heightened monitoring, then we will take that approach.
Got it. Mike, let me ask you a slightly different version of that question, which is, and we had a whole panel on third-party risk management earlier, and I thought one of the interesting takeaways from that panel was, there's third-party risk management guidance, which, as I said, is somewhat general, and yet I think everybody's agreed, and all the regulators have come to the view that there are some unique and specific risks associated with these kinds of complex partnerships involving one or maybe multiple fintechs. Acting Comptroller Sue likes to analogize it to a supply chain that's gotten longer and more complex over time, and therefore raises at least sort of more, we'll call it surface area for risk. And so with that general guidance on the one hand, and yet unique and fairly differentiated and a wide variety really of risks on the other, how should we think about the standards that regulators are going to be looking to impose here, and how, outside of reading tea leaves and consent orders, should people think about meeting those new heightened standards?
So first I would differentiate and maybe argue a little bit with you that we're not really imposing higher standards or enhanced supervision on any of these novel banks that are combined in this new portfolio. The fundamental principles of third-party risk management are the same, whether it's a traditional community bank or whether it's a more sophisticated, novel, and complicated community bank charter. The goal is to really emphasize those underlying principles, the operational risk exposure you have, the reputational risk exposure you have, our supervision program has always been risk-based and will always be risk-based. And so we're not going to write guidance to answer every single individual question on every type of technology, every type of relationship. It's just not possible. And it doesn't serve the broader purpose. The goal, and I think the better fintechs and the community banks that want to get involved in these more advanced relationships understand this, the better they will do, is that you really have to get to the basics. The block and tackle third-party risk management stuff from cradle to grave, right? From selection of that third party all the way through discontinuing the relationship if it's not working out, and all the monitoring that happens in between is the same, whether it's traditional community bank in a rural location, whether it's an advanced complex bank based out of New York City, same basic underlying principles. And that's where really investing time and understanding the principle-based guidance is what we would ask those bankers and the fintechs who want to partner with them to understand.
Yeah, and looking at that through the very specific lens of what are the actual risks that these specific programs create, and there's no one size fits all, in other words.
That's right, exactly right.
If I can add, because I worked on third-party risk management, I feel like I have to, double down on what Mike said. The guidance is intended to be principles-based. We got a lot of comments from the industry. A big part of the comments we got was they don't want it to be prescriptive. They want it to be principles-based, right? But the guidance also includes language that notes that banking organizations can calibrate third-party risk management based on the types of arrangements, the types of relationships they get into. So, and it covers all the various stages of third-party risk management cycle. It covers sound governance practices, and it gives examples. So we try to strike the right balance of being principles-based and giving examples. But to Mike's points, it would be impossible to really put out prescriptive guidance for every type of
for every little
arrangement.
edge case. Yeah, no, it's the age-old conundrum, right? And I think I used to joke when I was on the government side that the industry comes in and always wants principles-based regulation, and then you issue a proposal and they send very lengthy comment letters asking for much more clarity and detail. So that's how you get 1,000-page Volcker rules. But
I will add, though, that we continue to think about kind of what resources we can provide to the industry to clarify. Like, we have the Fintech Due Diligence Guide that was put out even before the guidance was published this summer. We're hosting an Ask the Fed session next week, Monday, actually, if I can put in a plug, where my colleagues will answer questions directly on the guidance. I work with my counterparts at the other agencies to host meetings or to host office hours, or really just think about what additional resources we can provide to support the industry.
Got it. Well, let's zoom out for a second. Natalia, let me turn to you and ask you how, you and the folks at Treasury are thinking about these partnerships specifically, but, more broadly, the impact of the entry of non-bank firms into the financial services space. It's created some complexity, raised some new risks, but, Treasury put out a report a little over a year ago talking about some of the benefits as well. So I'd love to hear from you about the current thinking in the administration on that.
Yeah. So one way to sort of think about competition and market structure, which a big part of that report was about, is through the lens of favorable consumer outcomes, which is sort of, I think, where I sit at Treasury and where most of you probably are working as well across the board. And so I think broadly for us to sort of think about competition in the market space, to think about responsible innovation, we as policymakers, like you said, should be sort of, keep that frame in mind and think about both opportunities and risks in the space, and sort of, again, think holistically about this. And so, looking at consumer finance space in general, the entry there has come primarily from non-banks. And I think a lot of the content in this conference sort of focused on that. But I think generally speaking, that also is creating competitive pressures and some complexity in the market space. And so we've already got into a little bit of a bank fintech partnerships there, but just to zero in broadly on what's happening in the market space is that obviously digital innovation is reducing barriers to entry. There's different business models. And so these particular changes are allowing non-bank fintech firms, particularly fintechs, to enter these core consumer finance markets quicker. And so many of these firms are also sort of leveraging data and technology to enter one particular narrow market space. So by unbundling some of these consumer financial products into more limited offerings, what happens is a lot of fintechs, a lot of non-bank new entrants are largely not subject to the same comprehensive regulation that IDIs, the insured depository institutions, are. And so at the same time, the IDIs that are present in the space continue to play a really important sort of role by providing the underlying infrastructure. And so that infrastructure supports many of these new entrant business models, and sort of the way they're structured is often that the IDI is providing the access. So like the fintech is basically sandwiching itself between the IDI and the infrastructure. So as a result of these sort of complex relationships between the IDIs and non-bank partners, there's an interesting dynamic in the market space where the new entrants and the IDIs are both competitors and collaborators at the same time a lot of times. And so in these ways, sort of these new non-bank relationships and business models are creating sort of complexity in the financial system. And I think the benefits there, collectively the research suggests that non-banks have been sort of reaching an expanded number of folks that potentially are underserved by the current depository system. And then if you look at sort of access to credit, there's a little bit of expanded access to credit through alternative approaches to underwriting. There is a little bit of a greater access to payments through sort of the use of more user-friendly and accessible payments tools. And then just generally, the increased access to lower transaction accounts, lower cost transaction accounts through digital channels. And so, some of our concerns on the risk side is obviously, harmful regulatory arbitrage. And again, one of the key recommendations out of that report was making sure that more so than focusing on any particular entry into the space or any particular type of the firm that's providing the services, it's really the level playing field that ought to be the focus sort of our competition agenda.
Yeah. Well, perfect segue to the question I was going to ask Will. And Will, thanks for your patience. You maybe strategically sat all the way at that end, so I wouldn't get to you. But I found you. So I did want to talk about something the CFPB did last week. The proposal to directly supervise larger participants in general use consumer payments. The theme of the release was very much to establish a level playing field. So maybe you could just summarize for us real quickly how you think about that. And more specifically, I know the director will be here later, and maybe he'll touch on it more broadly, but how it fits within this discussion around novel activities and partnerships that we're having, where you have this attenuated supply chain where maybe there is, if not regulatory, at least supervisory arbitrage, where the end, fintech offering services to the customers and directly supervised. The Bureau is addressing that, at least with respect to consumer clients, for some number of firms under its proposal. So why don't you tell us a little bit about that?
Sure. Four quick points on the proposal from last week. So the way our supervisory jurisdiction works, we have direct supervision specified in the statute with respect to a certain number of entities, like large banks or specific non-depositories in certain markets. In other places, we have to act in order to have supervisory jurisdiction. We can do that in a variety of ways. We can issue orders finding specific risks, or we can issue larger participant rules that bring under our supervisory jurisdiction non-depositories who are large players in particular markets. And what happened last week is a proposal to one of those. It's not yet finalized. It goes through the normal notice and comment process. And it covers general purpose consumer digital payments, so it's designed to pull in larger digital wallets and payment apps. It's sort of an important point to note that just because you are covered by a potential larger participant rule, that doesn't mean you might not already be subject to supervisory jurisdiction. There are lots of routes to supervisory jurisdiction, and just to note that. So next point, I think if you step back, you can see that our larger participant rules are generally one of two flavors. In some cases, they're pure gap filling. If it's a market in which depositories don't play a big role, then this is just extending supervisory jurisdiction to larger players in that market. It's a gap-filling supervisory function. In a lot of instances, from the Bureau's first larger participant rule that was about remittances to the latest one last week, it's fundamentally a level playing field play. These institutions, from a consumer financial protection statutory and regulation schema, they're subject to the same body of rules. They're subject to whatever it may be, Reg E, Reg Z, UDAP, Cranberry-Spliley, 1033 rules as and when they're finalized. And it's sort of fundamentally illogical for some of the larger players on the depository side to be covered by supervision and for the ones on the non-depository side to not be. And so that's the basic point of last week's proposal. Stepping back from that, beyond that sort of basic conceptual underpinning, why this level playing field larger participant rule now? I mean, obviously this is a market that has grown very fast, very quickly. It's also one in which we have a number of concerns about the risks associated with new non-bank players in these spaces, in particular big tech. The director has spoken about this at length, so I won't repeat the litany of issues, and we've issued a number of reports over the last year and a half in this area, but obviously there are a lot of concerns about new business models, a lot to do with how data is used, how data is monetized, and so forth. I think last point, it's important to realize what a larger participant rule is not, and sometimes you see coverage that gets this wrong. It's not an expansion of our regulatory jurisdiction. It has no effect on our regulatory jurisdiction. It also doesn't affect enforcement jurisdiction. In fact, we have general enforcement jurisdiction over non-depositories and the entities that are covered by this larger participant rule. It simply adds the supervisory tool to our compliance tool arsenal.
Yep, fair enough. So let me stick with you and broaden out yet further. And let's talk about the 1033 proposal.
Sure.
And I think the consumer data access is not necessarily brand new. Consumers have had the ability to link bank accounts in various forms for a long time, and it's been fairly common for 20-something years in the U.S. But it really has exploded, I think, in the last decade plus, and a lot of the fintech innovation you see is facilitated in one way, shape, or form by the ability to link accounts. And so one might ask why, why now with this consumer data access proposal? Now, other than the fact that Dodd-Frank says write a rule, and 12 years later or whatever, we're writing it now. Why now? What are you trying to achieve? I think there was a big focus on innovation and competition in particular in the discussion of the proposal. So I'd love to hear sort of how you guys are thinking about that now. I know you're in the middle of a comment period, so you're probably limited what you can say that's forward-looking, but give us the quick version.
I can say, if you start making arguments to me, then I have to take an ex parte note. But that's, so I think the proposal, more generally the agency, looks at the data access system and I think sees 4 shortcomings that the proposal is designed to tackle. At the most conceptual level, we think there's room for improved data access to drive competition, and we just, if you look at terms in consumer financial products, we think that account stickiness is responsible for APYs being too low, for APRs being too high, and whatever we can do to improve the data access system will have competitive benefits. So that's one of the things that is driving this. More concretely, I think we look at the current data access system and say it is not as safe, reliable, secure, and efficient as it could be. You have data providers who are sometimes withholding particular data fields, and that has prevented, standardization in the data access system. And part of what the proposal is trying to do is break some of those log jams so that standardization can then proceed. You have a lot of screen scraping as the main form of access still, even as APIs have taken hold, and there's a lot of things that are wrong with screen scraping from the safety and security and efficiency of data access point of view. It's not standardized, it collects too much data, credentials proliferate, the list goes on. And then even the developer interfaces, the APIs that have grown up are, they have residual, let's say that they are uneven in their effectiveness. I think you recently posted about a break-in service that you just experienced. I think the third bucket would be that we have concerns about the role of incumbent intermediaries. If you don't have a general regulatory framework and open and inclusive standards that are designed to fill that out, then the de facto source of standards can become incumbents exercising their power, and that creates the potential for rent seeking, and that's a problem that we would like to tackle in the proposal and the final rule. And then the last one, we think there's the data recipients, there's high risk that too much data is collected, used, and retained, and that creates a series of risks for consumers and for the system more generally. And those buckets tee up the basic structure of the rule, right? So you have a series of requirements that apply to data providers. That is the exciting subpart C for those of you following along. And there's a whole range of things in there that go to availability, like reasonable performance standards, data standardization, accuracy requirements, security requirements, limits on access caps, limits on fees, and so forth. You have then a series of requirements on the data recipient side. That is subpart D. The core obligation there is that data providers should only collect, use, and retain data as reasonably necessary to provide the product that the consumer is in the market to obtain. There are other provisions under that as well, like revocation provisions and so forth. And then the third aspect is that throughout the rule, we indicate that compliance with, conformance with fair and open and inclusive standards can be an indicia of compliance with particular provisions of the rule, and we see that as a means to promote open and inclusive standards that, again, can help tackle this problem of de facto standards not necessarily being the ones that we want to see, and more generally, it lets us provide a less detailed rule because, as technology and other forms of market practice evolve quickly, notice and comment rulemaking can't keep up with that, and therefore we want to rely on external standards in a greater part than perhaps is usual in our rules.
You mentioned account stickiness at the beginning of that, and I know that's something the director is focused on in terms of enabling consumers to walk away from bad products. Beyond that concept of competition, is there any broader sort of theory of competition that underpins the consumer data access rule, just in terms of making other options available and maybe catalyzing change within the incumbents? And I think we've seen some examples of that where, Chime, among many others, have offered, overdraft, no overdraft depository accounts through bank partners for a long time. And eventually, between that, the pressure from innovators and, in addition to regulators, you've seen change in behavior within the industry. Do you think that will come about in part as a result of the 1033 rule as well, or are you really focused on, helping individuals sort of switch accounts?
No, it's broader than. Look, account switching I think is an important use case, but it is clearly broader than that, right? There are lots of ways in which you can measure the effect of competition. It would not simply be in degree of account switching. It could be in improvements to pricing and service on existing accounts. It could be new, in the rate of new entrants into markets as barriers to entry lower because data access is easier and cheaper, and that then has effects of the kind that you just talked about. No, I think there's lots. Not all of these ways are easy to measure. To be, better products, it's hard to capture that in quantification. But no, I think it's a range of things on the price and quality of existing products, and then new functionalities with existing products, and then whole new products as well. And yeah.
All right. Well, I see Phil waiting in the wings. I have one final question for you, Natalia. In the non-banks report I mentioned earlier, the report said, from a policy perspective, there can be trade-off between regulation and competition, with chartering and regulation potentially limiting some new entry. And we've talked about competition across multiple dimensions today, how a lot of new entrants into the system are leveraging partnerships. Others try to go directly and enter directly into the banking system. That path has become very difficult in the last several years. I think over the last 12 months, we've had 2 new banks open, 5 new banks get approved, and 126 banks lost to consolidation. Are we, from the administration, from the Treasury's perspective, are we striking the right balance between new entry, again, taking any number of different paths through partnership or into the banking system or otherwise? Are we striking the right balance here in terms of creating enough competition in financial services?
Yeah, I think from where I sit at Treasury, the perspective there is really adopting as much of a consumer-focused lens on favorable consumer outcomes for this, right? So more so, again, than any sort of particular entry into the market space by any particular type of firm, it's the lens of like favorable consumer outcomes. We talked a little bit about benefits and risks there, but I also think a lot of conversations that took place today here about sort of evening, again, the level playing field on what regulation and what supervision and oversight applies is, again, one of the key findings in the report and key recommendations is the need for enhanced supervision, whether it's the LP rule, whether it's the 1033 rulemaking, which is of paramount importance for consumer data rights, whether it is TPRM and sort of the ongoing discussion there. I think these efforts are, more than anything, are important for driving favorable consumer outcomes.
All right, and with that, join me in thanking our panelists, and I'm really looking forward to the next sessions.
Thank you.